What's up, crypto fam? Get ready to dive headfirst into the most explosive market updates you absolutely cannot miss. The pace of change is relentless, and if you're not plugged in, you're missing out. Today, we're cutting through the noise to bring you the essential intel that's shaping the future. Are you ready to stay ahead of the curve? Let's go. We're kicking things off with a deep dive into the market's latest shakeup. Has Bitcoin shed its weak hands, and what does this mean for the future? We've got the on-chain data and expert analysis to break it all down. Then, we're asking the big question. Should you be buying Bitcoin right now, especially with prices hovering around that $120,000 mark? We'll explore the economic signals and institutional trends that could impact your decision. Next up, we're looking at the broader crypto landscape. Is Bitcoin price momentum weakening, and what are the on-chain activities telling us about network adoption? Get the granular details that matter. And finally, we're hitting you with the latest on major market movements, including liquidations and institutional interest in derivatives. Plus, a look at how the NFT space is reacting to the current market conditions. You don't want to miss this. Smash that like button, subscribe for all the breaking news, and ring that notification bell so you never miss an update. Bitcoin's weak hands exit as market consolidates. This market pullback is shaking out newer investors, potentially paving the way for stronger future growth. Bitcoin's recent price dip has led to a significant outflow of newer investors, who are realizing average losses of around 3.5%. This phenomenon, often termed weak hands exiting the market, is being closely watched by analysts as a potential precursor to a more robust market base. On-chain data indicates that while newer participants are selling, more established short-term holders, SDHs, those holding for 1 to 6 months, are maintaining their positions and are currently sitting on an average unrealized gain of 4.5%. This divergence in investor behavior is being interpreted by some as a bullish structural development, suggesting a healthier distribution of Bitcoin among more committed holders. The market experienced a significant liquidation event, with over $70 million in leveraged long positions being wiped out, as Bitcoin briefly fell below the $111,000 mark on major exchanges. This sharp deleveraging event caused a notable drop in open interest and a substantial decline in cumulative net taker volume, indicating strong selling pressure. Analysts suggest that the absence of a short squeeze following this liquidation could signal underlying upside potential, particularly if Bitcoin can reclaim critical support levels. The 20-week exponential moving average, EMA, currently around $108,000, is being closely monitored as a key indicator for potential near-term recovery. Historically, this level has acted as a strong dynamic support during bull market rallies. Looking at broader market indicators, the current sentiment does not align with typical bull market top formations. Many of the commonly used metrics for identifying peak market conditions remain in neutral territory. For example, the Puell multiple, which measures miner revenue relative to Bitcoin's price, stands at 1.39, far below the historically overbought threshold of 2.2. Similarly, the MVRV Z-score, which assesses Bitcoin's market value against its realized value, also remains within neutral bounds, suggesting that the market is not yet exhibiting signs of overheating typically seen at cycle tops. Future price action will likely depend on Bitcoin's ability to hold key support levels. A decisive move back above the $117,000, $118,000 range could act as a significant catalyst, drawing in further buying pressure. However, a failure to hold the 20-week EMA could lead to a deeper correction, potentially targeting the 50-week EMA, which has historically marked local bottoms during previous bull cycles. Despite the short-term volatility, long-term projections remain optimistic. Bitwise, a prominent crypto asset manager, has forecast a compound annual growth rate, CAGR, of 28.3% for Bitcoin through 2035, predicting a potential price of $1.3 million. This outlook is underpinned by the increasing institutional adoption of Bitcoin as a core asset class and its inherent supply inelasticity. But what does this consolidation mean for your investment strategy? We'll explore whether now is the right time to buy Bitcoin amidst these market shifts. Should you buy Bitcoin while it's under $120,000? With Bitcoin's significant recent gains and a shifting economic landscape, investors are weighing the risks and rewards. Cryptocurrency markets have seen a remarkable surge over the past year, fueled by a more accommodative regulatory approach from governments and a general wave of investor optimism, albeit with a speculative edge. Bitcoin, the flagship cryptocurrency, has been a major beneficiary, skyrocketing an impressive 76% in the last 12 months alone. This broad-based optimism extends to traditional markets as well, but recent economic indicators suggest a potential slowdown, raising questions about the sustainability of these high returns. Historically, Bitcoin has demonstrated remarkable resilience, bouncing back strongly after considerable pullbacks. This has led many to ponder whether the current price point, still under $120,000, represents a favorable entry opportunity. The initial catalyst for Bitcoin's recent ascent is often traced back to the election of President Trump, with investors anticipating a more crypto-friendly administration. This anticipation proved largely accurate, as the administration has since rolled back certain cryptocurrency regulations, announced strategic Bitcoin reserves, dropped legal actions against crypto firms, and even seen the launch of associated meme coins, all contributing to a more favorable environment for crypto prices. More significantly, Bitcoin has garnered substantial momentum through increased institutional acceptance. The launch of nearly a dozen spot Bitcoin exchange-traded funds, ETFs, over the past year has provided a more accessible and credible avenue for traditional investors to gain exposure to Bitcoin's price movements. This institutional backing has lent Bitcoin a new level of legitimacy within the mainstream investment world. However, the rapid price appreciation of approximately 76% over the past year has also sparked concerns about the market being potentially frothy. This surge is partly attributed to a general optimism across all investments, including the stock market, buoyed by several years of economic resilience. Yet, recent economic data points to a potential deceleration. Revised hiring figures for recent months have been significantly lower than initially reported, and July's job growth also came in slower than expected. Furthermore, economists express concern that the impact of ongoing tariffs could eventually lead companies to pass increased costs onto consumers, potentially dampening consumer spending. A combination of slowing hiring and reduced consumer spending could impede economic growth, prompting investors to divest from riskier assets like Bitcoin. Therefore, investing in Bitcoin at this juncture is advisable only for those whose portfolios can withstand substantial volatility and who are prepared for a long-term holding period, rather than short-term trading. The cryptocurrency's propensity for dramatic price swings means that negative economic data, such as another weak jobs report, rising inflation, or persistent tariff-related news, could trigger a rapid decline in its value. Nevertheless, for the patient investor, Bitcoin remains a compelling long-term prospect. Its growing institutional acceptance and the ease of access via ETFs could solidify its position in investor portfolios for years to come, even amidst inevitable price fluctuations. While the institutional adoption is a strong bullish signal, are the current on-chain metrics confirming this positive sentiment? We'll delve into the latest on-chain activity and technical indicators for Bitcoin. Bitcoin price remains under pressure. Despite minor bounces, weak on-chain activity and seller dominance suggest a challenging recovery for Bitcoin. Bitcoin has seen a slight recovery from its early Asian session lows, inching back above the $110,000 mark. However, the prospects for a sustained upward trend appear dim, as critical on-chain activity metrics indicate a slowdown in network adoption and a lack of strong demand. Analysts point to weakening price momentum, with the Relative Strength Index, RSI, nearing oversold territory and a bearish moving average convergence divergence, MACD signal. Further compounding these concerns, the spot cumulative volume delta, CVD, is showing a negative reading of $199 million, indicating that sellers are currently in control of the market. This is corroborated by spot volume data, which signals a deficit in demand. Adding to the bearish sentiment, daily active addresses, DAA, have fallen to 692,000, dipping below the typical low band, which is a strong indicator of reduced network participation. This decline in active users suggests waning interest or utility on the Bitcoin network itself, independent of short-term price action. The broader cryptocurrency market is also reflecting this pressure, with key market indices experiencing declines. The Bitcoin Bulletin 20 and Bitcoin Bulletin 80 indices were down 2% and 1.7% respectively over a 24-hour period, mirroring the general sentiment of caution and reduced trading activity. This widespread underperformance suggests that the current downturn is not isolated to Bitcoin, but is affecting the wider crypto ecosystem. Adding to the complexity, the crypto derivatives market shows mixed signals. While leveraged crypto bulls have faced significant liquidations, with over $940 million in futures bets, predominantly long positions, being burned in the past 24 hours, overall open interest, OI, in Bitcoin remains elevated near lifetime highs. This suggests that despite liquidations, a substantial amount of capital is still positioned in the futures market. However, open interest in Ether and other altcoins like Solana, XRP, and Dogecoin has seen a pullback, indicating net capital outflows from these assets. Despite these fluctuations, funding rates for most major tokens remain positive, hinting at a continued dominance of bullish long positions in the perpetual futures market, excluding certain altcoins. Institutional interest in regulated derivatives also appears subdued. Open interest in CME-listed standard Bitcoin futures has recently reversed a minor uptick, suggesting that institutional engagement with these traditional instruments remains low. Conversely, options markets are showing increased activity, with open interest in both Bitcoin and Ether options reaching multi-month highs. Notably, the upcoming multi-billion-dollar expiry on Deribit indicates a leaning towards Bitcoin put options, signaling concerns among traders about further price drops. Ether options, however, present a more balanced outlook. Flows on over-the-counter, OTC, desks reflect diverse strategies, including outright put buying and put spreads for Bitcoin, alongside calls and risk reversals for Ether. This indicates sophisticated market participants are actively hedging against potential downside or positioning for specific directional moves. Given these mixed signals and the pressure on Bitcoin's price, how is the broader digital asset market performing? We'll turn our attention to the impact on the NFT market and key derivatives. Yahoo Finance, Bitcoin price under pressure, NFT market slumps. Bitcoin faces recovery challenges amidst weak on-chain activity, while the NFT sector experiences a significant downturn. Bitcoin has managed to rebound from session lows near $108,760 to trade above $110,000. However, the outlook for a sustained recovery remains uncertain due to sluggish on-chain activity, which points towards weakening network adoption. Technical analysts highlight diminishing price momentum, with the RSI approaching oversold levels and a bearish MACD signal. The spot CVD at $199 million underscores seller dominance, and declining daily active addresses to 692,000 suggest reduced network participation. The broader crypto market, including the CoinDesk 20 and CoinDesk 80 indices, is also under pressure, down 2% and 1.7% respectively. In the derivatives market, leveraged crypto bulls have suffered substantial losses, with approximately $940 million in futures positions liquidated over the past 24 hours, the majority being long positions. Ether alone saw $320 million in liquidations. Despite these liquidations, Bitcoin's overall open interest, OI, remains high, near lifetime peaks. However, OI for Ether and other major cryptocurrencies like Solana, XRP, and Dogecoin has decreased, indicating capital outflows. Funding rates for most tokens remain positive, suggesting a persistent bullish sentiment among leveraged traders. Institutional interest in regulated CME Bitcoin futures has seen a slight pullback, reversing an earlier minor bounce. This indicates a plateauing of institutional engagement with these traditional derivative products. In contrast, the options markets for both Bitcoin and Ether are showing increased activity, reaching their highest levels in months. On Deribit, the upcoming expiry shows a notable bias towards Bitcoin put options, signaling market apprehension about further price declines, while Ether options present a more balanced view. The NFT market has experienced a sharp correction, with blue-chip collections facing steep weekly losses as Ether pulled back from record highs. This downturn has wiped over 10% off the value of most top NFT projects. Pudgy Penguins, a leading collection, saw a 17% drop, while Bored Ape Yacht Club, BAYC, fell 14.7%, and Doodles experienced one of the sharpest corrections at 18.9%. Even secondary projects like Moonbirds and Lil Pudgies saw significant declines. CryptoPunks, however, proved the most resilient, losing only 1.35%, reinforcing its status as a defensive benchmark in times of collapsing risk appetite. Despite the lower floor prices, trading volumes remained robust, with Pudgy Penguins leading the pack. However, the overall NFT market capitalization has shrunk by nearly 5% to $7.7 billion, a significant drawdown from its recent peak, highlighting the rapid capital flight from the sector when ETH experiences volatility. The resilience of CryptoPunks amidst broader declines further solidifies its appeal as a collateral asset, demonstrating liquidity that holds up even as other NFT floors collapse. This performance suggests that while most NFT blue chips act as high beta proxies for ETH, legacy projects like CryptoPunks offer defensive value, making them a safer long-term bet for institutional investors. These market movements paint a clear picture of the current landscape. What are the key takeaways from today's updates? We'll wrap it all up with a quick recap and a call to action. All right, let's do a rapid-fire recap. Bitcoin's seeing weak hands exit as the market consolidates, setting up for potential future strength. We're debating whether to buy Bitcoin under $120,000 amidst economic uncertainty and institutional adoption. On-chain data shows Bitcoin's momentum is weakening with lower network activity, and the NFT market is feeling the pressure with significant price drops across major collections. Don't miss out on any of these crucial updates. Hit that like button, subscribe to Bitcoin Bulletin for your daily dose of crypto intelligence, and ring the notification bell so you're always in the know. Follow us on all social media platforms for more insights and join the conversation. We'll see you in the next one.